Good day, Golearners. Today we are going to be, in this module, we are going to be talking about different markets in the cryptocurrency space, the places you can invest your money in the cryptocurrency market. So the first one we are going to be talking about is the spot market. Now, the spot market is where you buy cryptocurrencies at their market price with no leverage. You are buying it originally. So if a coin is worth $1 and you have $1,000 with you, it means that you'll be having 1,000 units of that coin. So whenever the coin goes, if the coin goes to $2, you have the net worth of your portfolio will be $2,000. So literally you are just, that's what we call spot market buying. You are buying at the market, you are buying at the spot market with no leverage, no increased buying power. It is just your money and the coin you own. The advantage of this is that you are not, the risk you are only prone to is the price of the coin falling. It's only the price of the coin falling, that's where you can see the risk. But there are no downsides to it other than that, and it is most likely where people go for peace of mind. So the next market we are going to be talking about is the margin trade. Now let me explain. When you trade on margin, you are literally increasing you are basically increasing your buying power, in the sense that if I'm with $1,000, my broker or the exchange can borrow me $9,000, so I can be trading with $10,000 to buy a coin. So it means that I'll be holding $10,000 to buy a coin of $1. So if I'm buying a coin worth $1 per coin, I'll be owning 10,000 units of that coin. So if that coin moves to $2 per coin, it means that the net worth of what I'm holding will be how much? $20,000. So if I'm to return the $9,000 I was borrowed by my exchange, I will give it to them. I'll be left with 9,000 minus 20. That will be $11,000. So I just used $1,000 to raise $10,000 to get a profit of $10,000. So over time, you know that it is profitable when it's in your way, but it is not when it goes against you. Now, if the price of that coin moves from $1 to 0.5, it means that the investment is halved. So it means that you'll be having the value of the investment will be $5,000, but you owe the exchange $9,000. Tight corner, isn't it? So over time, you will know that the margin trade goes in your favor when the margin trade goes in your favor when the price goes in your favor. So the only way I would advise for you to be in the margin trading is by doing thorough price analysis on the coin you are buying to know whether it is buy or sell. And most times this thing is for short-term gains, so you don't go into those margin trades for the long run. You can't be in a margin trade the way you are in the spot market. So different types of margin trading. We have the futures market. Now the futures market is a place where we bet on the futures price of a commodity, of an asset, or a cryptocurrency. So if it's just like an agreement between you and your exchange that you will get a certain cryptocurrency at a certain price in the future, at a time in the future. So the futures price, most likely it fluctuates, or it diverges away from the spot price slightly, because people are betting on the price going either higher or lower than the current price. So the futures market gives us a picture. The futures market, it trades on leverage. One, leverage is also margin trading, and it is a disparity. There's a disparity between the futures price and the spot price. So now the futures market, especially on Binance, you can trade on leverage times up to times 125 of your capital. So if I'm with $1,000, I can be having an increased purchasing power of $125,000. But it is highly risky because you can lose all your investment. That's the downside. So before you go into the futures market, you have to know how to do proper price analysis. This all boils down to price analysis on a coin. You need to know how this coins, you need to know how the coin is going to move in the short term. As I said, you don't hold margin trades for long. You hold them for a period of within a day to 3 days, because that's when you know your target will be met. But it's only when you are really sure you can hold a futures trade for a very long time. Like I've been holding XRP futures trade since when it hit $1. So currently the price is on 1.8 and I'm on times 10 leverage. So over time you see that it's because I was really sure of the price movement. XRP has been hitting all-time highs. This is at it hits $2 today. $2, this is the highest it has ever been since 2017. So that analysis I did was based on the price check I did before I took the trade. I knew XRP from $1 would get to $2 in a time span. So that is just basic price analysis. So the next one is the derivatives market. The derivatives market consists of options and different financial investment vehicles where you can invest your money, but they are not really popular and it's very complex. Like options trading. An option is basically is a contract where you pay a down price for a commodity or an asset or a cryptocurrency in hope for getting it in the future. So if it goes with you, fine. There are two types of options. We have the call option and the put option. So if you are expecting it to go up, you buy that. That is a call option. If you want it to go down, that's the put option. So that's where we come into the complexities of this derivatives market. But in this our module, we are going to be in this cryptocurrency trading course. We are going to be delving into the nitty-gritties of the basics of the cryptocurrency market. So over time, we will get to know and get to understand how the options market work. So the last one is leverage tokens. On Binance, they call them ETFs, exchange trading funds. Now, these leverage tokens, is a type of derivative product that gives you leverage exposure of an underlying asset. Now, let me explain. It means that normally, if I'm to buy a coin and it goes up 10% in a day, I can buy a leverage token of that coin that will give me more. Now watch. If I'm to get XRP, for example, XRP has gone up let's say 30% today, let's say 40% today, and I decide to get XRP up. XRP up is betting on the price to go up, but the leverage is ×3. So it means if XRP, the cryptocurrency, goes up 30%, the XRP up will go up ×3, 90%. So it makes it easier. It makes it easier for you to maximize your returns in this market. It makes it very easier for you to maximize the returns. So you'll be able to, if others are holding XRP and they are getting a return of it's 120, you are getting a return of 40%, you are getting a return of close to 120%. So this is where you can earn more in the cryptocurrency market. So all still boils down to price analysis, because if XRP goes down by 10%, XRP up will go down by 30%. So that's why you need to know the kind of analysis you need to do when you are entering the cryptocurrency market, especially when you are dealing with this specific kind of market, this unique market. So if you can see my screen, you can see where you can see Binance leverage tokens. On the right hand side, you can see returns. Good things come in threes. So this is an FTX exchange leverage token that is under advertisement. So in the next module, we are going to be discussing price analysis into details. So we'll be delving into the basics and the nitty-gritties of the price analysis of cryptocurrencies. See you in the next module.